Hey everybody, and welcome back to Investing with Wesley. If you follow me on Instagram, then you've probably noticed some of the stories that I've put on my Instagram over the past couple of days. The past couple of days I gave you some rules to follow whenever you're investing in options. These aren't necessarily catch-all rules, but they're just the top 3 rules that I personally use whenever I'm deciding to engage in buying options. So in today's episode, I want to give you those 3 rules as well as show you an example of those rules in action and exactly how they're possible and how they work. So with that being said, let's get into it. Okay, so for starters, let's give a brief explanation on what options are. Options are a different kind of investing. When you think of investing, more often than not, you're just thinking of stocks and buying one share of a particular company. But an option is actually a contract that gives you the option to buy a particular stock at a particular price within a certain amount of time. So as an example, let's say that XYZ company was trading at $10 per share, and you purchased an option contract that gives you the right to buy 100 shares of X, Y, and Z company at a strike price of $5 per share. This means that you have the right to buy 100 shares of this company at $5 per share, even though it's currently trading at $10 per share. Now, obviously, playing with this kind of power when it comes to investing means you're paying a premium. You have to pay a premium for every option. And the scary thing about options is that every single option expires worthless. So if it turns out that you're wrong about your decision and the company doesn't do well or doesn't go in the direction you think it's going to go, then the option contract that you purchased actually expires worthless, and you lose all the money that you paid in premium to have that option. Now, although that might sound scary to some, meaning it's all or nothing, options can actually be used and certain strategies can actually be developed to lower the amount of risk that you're exposed to. Now, because option investing can be extremely risky, I follow a very strict set of rules. The first rule is I never invest more than 10% of my portfolio's worth in options at any one time. Now, I could choose to use that 10% all in one option, or use that 10% of my portfolio's value across different options. Point being is I never risk more than 10% of my portfolio value in these options. Now, the second rule might seem unbelievable at first. Now, the second rule is that the risk you take should produce a large enough reward that it grows your entire portfolio by 15% or more. Meaning that the 10% of your portfolio that you risk should give you such a large return in these contracts that it gives you a gain across your entire portfolio by 15% or more. Now, usually it means that the options you're investing in have to grow by 120% or more to make this happen. Now, let's stop right there real quick, because already I know that you're wondering how an option contract could give you 120+% returns with such little capital invested. And that is exactly how options work. When investing in options, and how the prices of options are calculated is something that is determined by what's called the Greeks of options. Now, when it comes to the Greeks, there are 4 main ones. There is delta, gamma, theta, and vega. And these Greeks all come together to determine the extrinsic value of these options. Now, when it comes to just your standard investing of buying shares, that is something you want to calculate the intrinsic value of to determine if what you're buying is at a fair price or if it's overvalued or undervalued. When it comes to options, the price is calculated 2 different ways. There is the intrinsic value of the option, meaning however much money your strike price is in the money determines its intrinsic value. So in the previous example, I told you that our strike was at $5, but X, Y, and Z company was trading at $10 per share. We are in the money by $5, meaning there's an intrinsic value in these option contracts of 5 because we're in the money by $5. Now, that's intrinsic, but there's also the extrinsic value of option contracts, and these are determined by those Greeks. As an example, the delta is how much the price of that contract will go up for every $1 that the underlying share goes up. And this is where you could see some of those massive gains in options contract. So let me give you a real-world example of a trade I did just last month when a Black Rifle Coffee Company went public. Now, before they actually went public, I invested in 5 different option contracts with the SPAC that was publicly traded that they were using to go public. Now, this method doesn't really work if a company goes public the traditional IPO route. However, if they go public with a merger like in an SPAC, this strategy that I did works perfectly. I bought 5 different option contracts of that SPAC, of the company that was already publicly traded that was eventually going to merge with Black Rifle Coffee. But honestly, all those details don't really matter. The point is that I bought 5 contracts at $114 per contract. Now, the total value of the account I was investing in was just under $6,000. So if you follow the math, I actually spent $570 from this account, which is just under that 10% mark. I risked 10% of the total account's value on these options. That was me following rule number 1. Now, rule number 2 took a little bit of guessing and trying to predict the future. I knew this company was extremely popular and they were going public soon, meaning I knew that the share price was going to skyrocket. Now, it could have been very short term or it could have been long term. Come to find out a couple weeks later, it was very short term. And I actually sold my option contracts early. The expiration date that I purchased was actually all the way out into April, and I sold these contracts in February. So I sold them early, but I also sold them for a profit. When Black Rifle Coffee Company actually went public the day of the merger and their shares were publicly traded, their stock price skyrocketed. And because of that, so did the value of my contracts. Remember that option contracts take the intrinsic and extrinsic value to give you the contract price. Now, I sold my contracts when the underlying stock was trading at $15 per share. So there's already $5 worth of intrinsic value in these contracts. But then you also have to factor in the extrinsic. Remember the Greek delta. For every dollar that the share price rises, the contract value goes up by that delta amount. Now, when I purchased the contract, the delta was at 0.2 or $20. So for every $1 that the underlying share went up, my contract rose by $20. And this is how you can see that you can get those extremely large gains. The underlying share price only rose $5, giving us an intrinsic value to start with of 5.0 or $500 per contract. Also factoring in delta of 0.2 and adding that to the contract price 5 different times because it went up $1 5 different times gives us an extrinsic value of 1.0. So you take the extrinsic and the intrinsic, and the total value per contract that I was holding on to was 6.0 or $600 per contract. Remember, I spent $114 per contract and I bought 5 of them. But part of me was still fearful because it's a brand new publicly traded company and I wasn't sure how many people were actually going to be trading in these options. So instead of putting up a sell order for the $600 per contract worth of value that I was holding on to, I actually did a little bit less than that. I put a sell price of $550, and almost immediately all my contracts sold for a value of $2,750. I managed to turn $570 into $2,750. Now, relatively speaking, that's not a whole lot of money, but the gain on that is astronomical. Just by itself, it's about a 380% gain, and factoring that into the total portfolio value, the total portfolio value went up by 36%. So now that you know all of this, let's break down the last 2 rules. Remember, the second rule is that the amount you risk should be able to give you such a large amount in return that it raises your total portfolio value by 15% or more. And that to make this happen, your option contracts needs to go up by 120% in value. Now, needless to say, we vastly exceeded that 120% and exceeded that 15%. And I did this by accurately predicting that the share price was going to go up. And honestly, that part was the easiest. Because as we all know, there's a lot of hype when it comes to IPOs. And even if the company isn't worth actually investing in long term, people will always buy the IPOs, so the share prices are almost always bound to rise. Factoring in the potential intrinsic value and the extrinsic value that the Greeks tell me, I felt I had an extremely good chance of making this trade profitable within the rules that I have set up. Now lastly, the third rule is something that not many people pay attention to, and that is that the options you trade shouldn't negatively affect your portfolio's Sharpe ratio. Now, for those that don't already know, the Sharpe ratio gives you a number that basically tells you the average return that your portfolio gets that is in excess of the risk-free rate. Now, breaking all that down into simple English, this ratio basically tells you the average returns that you get compared to the risk. A Sharpe ratio of 1 is considered good, a Sharpe ratio of 2 is considered great, and a Sharpe ratio of 3 is basically considered excellent or perfect. So we're really playing with small numbers here, but basically anything less than 1 is not ideal. Now, when setting up your portfolio, you often want to compare yourself to a benchmark. My benchmark is always the S&P 500 or the market as a whole. And my Sharpe ratio will tell me if I'm getting better returns at a lower risk than the S&P 500 as a whole. The goal of trading these options is not to make your portfolio more risky in hopes for greater returns. It is to take a calculated risk and only risk that 10% of equity to gain that much more. So the final rule is to basically make sure whatever contract you're investing in when it comes to options trading isn't giving you unnecessarily high risk. It should be a relatively low risk compared to an extremely high gain. And again, we do that by only risking 10% at any one time and using the intrinsic and extrinsic value of these option contracts to reasonably believe that you're going to get an extremely large return. I hope you got value in this video. If you did, please remember to like and subscribe. And I know option contracts can be a little confusing, so either message me on my dedicated Facebook or Instagram account, or just leave a comment down below with any questions you might have, and I'll gladly answer them. But until the next episode, have a good one.